Even the banks, which are no friend of gold, and for a lot of reasons we get into, can't deny that it's going to rise because of the inflation to come, the stagflation to come, and the debasement to come. But just in April, I do read these letters from the private wealth management arms at UBS or Goldman Sachs. Goldman Sachs is, whether you like it or not, is the biggest investment bank in the world. And their top commodity analyst is very constructive on gold. He's looking at Iran, at this war, at inflation, and longer term for gold. He's very bullish. And even Goldman Sachs CIO is extremely bullish on gold because they're seeing low rates. They're seeing energy supply disruptions that's going to take years, not months, to repair. The dollar is going to fall because of deficits, and to pay those deficits with printed money. And that's just, to me, undeniable.
Financial analysts with JP Morgan and Morningstar project continued strength in the gold market. If the global conflicts remain unresolved and central banks maintain their current rates, gold will continue to act as a safe haven asset for both institutional and retail investors. Because of these factors, experts with JP Morgan and Morningstar believe that gold will perform well this year, with sustained higher prices in 2026. Renowned expert Matthew Piepenburg notes that major institutions like Goldman Sachs, JPMorgan Chase, and the International Monetary Fund also increasingly view gold as a key reserve asset over fiat currencies. Recent price declines are driven by short-term liquidity pressures rather than fundamentals, as investors sell gold to cover losses elsewhere. He predicts these pullbacks are temporary and expects gold towards $8,000, supported by ongoing economic stress and monetary instability. Concurrently, Piepenburg explains that gold's long-term rise is supported by expanding money supply, persistent inflation, and weakening confidence in fiat currencies. He notes that central banks continue to increase gold holdings, particularly after the US dollar's use as a geopolitical tool, which has accelerated global diversification away from dollar reserves. In his view, gold is gradually re-emerging as a core reserve asset, while the dollar's dominance slowly erodes. In his analysis, Matthew Piepenburg adds that recent forced selling by governments and institutions during liquidity stress should only be considered as temporary pressure within a broader uptrend. Investors should focus more on central bank and major institutional behavior than short-term narratives, noting that even mainstream banks now project higher gold prices amid inflation, deficits, and geopolitical uncertainty. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Matthew Piepenburg's recent interview.
For gold longer term, obviously I have a bias as a gold executive with a gold business and partners in Zurich in Switzerland, but this bias is shared by bankers at Goldman Sachs, JP Morgan, UBS, the IMF, the BIS. It's shared by the central banks of the world. So it's not just a gold bug bias. We're looking at the direction of gold as a more trusted reserve asset than a debased ice cube melting US dollar or any paper currency. So these are all longer term tailwinds for gold. The price reductions we've seen because of sell-offs in gold to cover other losses like margin costs, literally, which we can talk about. But the longer term direction for gold is going to be much higher for the end of this year. My base case is at least 6,500. Probably over 8,000 in US dollar terms. So these sell-offs for liquidity, because of a liquidity shortage right now during the war, are just going to be tailwinds for a much higher gold price longer term. And our view at Von Greyerz is always longer term. And these are buy signals for us and our clients right now. To me, 2025 was the first couple innings or the first half of a soccer match, not the end of the game, and certainly not the floor for gold or the high for gold either. But you got to keep it simple without being simple stupid. Historically, this is what we understand gold as at Von Greyerz, and our clients understand it. And I think sophisticated gold investors understand this. Look, gold is real money. Central banks are seeing this. Pre-1971, central banks, 70% of their reserves were in gold. Today, it's only 30%. It's climbing, but it will get to at least 50% for all the reasons we've been discussing. Gold is becoming the de facto primary reserve asset, the new FX reserve currency. In that world, gold is increasing in dominance and the dollar is falling. We cannot underestimate the fact that Central bank gold stacking has increased by 5x since the US dollar was weaponized against Putin in 2022. Again, regardless of what you think of that war, weaponizing a neutral reserve asset like the US Treasury and the US dollar caused a massive distrust for that dollar. And the gold we see being stacked by central banks is undeniable. Our argument has always been that gold is not rising, the dollar is falling. The US money supply, M2, which is far more important than M0, went from 15 trillion to 21 trillion during COVID. And that was a 40% increase in dollars in 2 years. And then after that, there was another 30% increase. That's the definition of inflation. Milton Friedman, it's the money supply. You can look at other ratios like M2 money supply to the gold price. That ratio today is around 4.6. It's been as low as 2.5 in the 80s. I think we're heading in that direction of compression. The other one that a lot of people are talking about in the gold space is the market price of U.S. official gold to its foreign U.S. held treasuries. That ratio, that percentage is about 14%. In 1989, it was 20%. And in the last 80 years, it's gone as high as 40 to 60%. So for gold in that ratio to even get to 50%, to get to somewhere in that ratio, gold would have to triple to get to 50% of U.S. gold to foreign held U.S. treasuries. Again, I think the tailwinds are very obvious. But for me, aside from those kind of data points, historical data points, what we're seeing right now with some of the sell-offs, which are totally to be expected, it isn't because gold is topped. It's a classic liquidity squeeze. It's a paradox of central banks, hedge funds, investors, and nations having to sell the good to cover the losses and the bad. Gold is the most liquid and valuable asset to sell. Turkey, for example, just sold 10% of its gold in Switzerland in the last 3 weeks because that's 60 tons of gold. And they had to do this because 90% of Turkey's oil and gas is imported through the Middle East, and they have to buy that in dollars. So they needed dollars to buy gold. But what's interesting about Turkey is they didn't just sell their gold in Switzerland. They did a swap. Without getting into the complexities of a swap, they were just using gold as collateral for dollars, but they want to get that gold back. It's kind of like a pawn shop where you can put grandma's jewelry on hold and then buy it back later. But they're forced sellers of gold, not because they think gold is less important. Turkey has been a net stacker of gold for years because they see its value. In a crisis, they have to sell the best asset. Saudi Arabia and other Gulf states have done the same thing for different reasons. They have plenty of oil, but they import all their food and other things from the rest of the world. They need dollars to do that. They had to sell their gold to get dollars. It's a forced sale. It's not a desired sale. It's driven by this war. You see the same thing in ETFs. A lot of that was 2 to 3x levered ETFs. These investors were not wealth preservationists, not long-term thinkers. They got their stop signals. They had to sell. The hedge fund space sold a lot of gold, probably 22 tons of gold since this war started, not because it's the end of gold, but because they need cash. When the Middle East made their stocks go down, so lots of levered losses in the hedge funds. Sometimes if they're 5x to 40x levered, when big funds see a panic sale, that's usually a sign that they're selling their gold at a margin to cover margins. And throughout my experience in Wall Street, when you see a massive panic sale to cover losses, it usually means the smart money sells this aggressively. When that happens, you usually see that as a massive reversal afterwards. And I think the most important thing, and I can't believe I'm saying that, if you want to know the price direction of gold in the future, you've got to watch what the banks are doing rather than what they're saying. Pre-war, even before the war started, early in 2026, the year-end gold price targets for Goldman Sachs and JP Morgan were 6,300 as a base case and 8,300 as a possible target, 8,500. So even the banks, which are no friend of gold, and for a lot of reasons we get into, can't deny that it's going to rise because of the inflation to come, the stagflation to come, and the debasement to come. But just in April, I do read these letters from the private wealth management arms at UBS or Goldman Sachs. Goldman Sachs is, whether you like it or not, is the biggest investment bank in the world. And their top commodity analyst is very constructive on gold. He's looking at Iran, at this war, at inflation, and longer term for gold. He's very bullish. And even Goldman Sachs CIO is extremely bullish on gold because they're seeing low rates. They're seeing energy supply disruptions that's going to take years, not months, to repair. The dollar is going to fall because of deficits, and to pay those deficits with printed money. That's just to me undeniable. And it's undeniable to even Goldman Sachs, which I never thought I'd quote to support the gold price.
Regarding shifting global geopolitics, Matthew Piepenburg explains that tensions between the U.S. and major energy producers like Saudi Arabia are gradually weakening the traditional petrodollar system. He notes that since the U.S. has increasingly used the dollar as a geopolitical tool, countries such as Saudi Arabia, China, and other OPEC members have explored settling trade outside the dollar, with gold emerging as a neutral settlement asset. This signals a slow but steady move toward de-dollarization and a more multipolar monetary system. Meanwhile, Piepenburg warns that the global financial system remains highly fragile due to rising debt levels, higher interest rates, and pressure building in bond markets. He highlights that economies are vulnerable to shocks such as unemployment spikes, yield increases, or credit stress, which could trigger broader financial contagion. However, equity markets appear overly optimistic, pricing in a quick resolution to global conflicts, while underlying risks in sovereign debt and private credit continue to build beneath the surface. Let's jump into the interview.
You can remember the Saudi Arabians, Royal Prince or Highness, shaking hands warmly with Xi not too many years ago. I think it was 2024, but just fist pumping Biden, who had called Saudi Arabia a pariah state. So it's a very tenuous relationship between Saudi Arabia and the U.S. The OPEC deal made in the early 70s, the petrodollar deal was effectively made at knife point. And since we weaponized the U.S. dollar in 2022 and the Ukraine war and the Putin sanctions, again, whatever you think of those, Saudi Arabia and China and the OPEC nations have been in discussions behind the scenes and in front of the scenes about selling oil outside of the U.S. dollar. And we've seen Saudi Arabia importing massive amounts of gold from Switzerland, where I work out of, and then using that gold to buy Chinese imports, which have increased dramatically since 2022 when we weaponized the U.S. dollar. So gold is clearly involved here as a net settlement asset, as a neutral asset. And I'm not saying that, again, the petrodollar ends tomorrow. What I am saying is the oil market is 9 times the size of the gold market. So as gold becomes more important and the dollar becomes less important, you got to think about what that means for the longer term direction of gold. And the other important party here is the world itself. As you indicated, Anthony, the global supply chains impact the cost of everything, not just oil or gas or food. It's a far more fragile global system than we think. And I remind that even the great financial crisis in 2008, that was led by a small mortgage crisis. Truly, only 5% of U.S. mortgages had to fail to create a global financial sell-off. And if we see a similar event in subprime or even in private credit, the system's very fragile. If we get to 10% unemployment in America, that could be a recession. That could have a contagion effect on the markets. If we see 10-year yields go above 5%, that could be another needle that hits this very fragile market balloon. Europe is getting weaker. The UK's military influence is weak. Its oil needs are high. Australia was running out of diesel. Dependent, dependent nations like India or Turkey or Japan or South Korea, which get 50 to 90% of their oil through the Middle East, Southeast Asia, Taiwan, liquid natural gas, etc. These are going to hurt these economies as well at the same time that the U.S. economy and markets and inflation are at risk. Again, markets were assuming a very quick and peaceful solution. But your country, the EU, is becoming wholly dependent on U.S. oil and gas because Russia's off the table. And I'm reminded of Kissinger's famous quote that to be an enemy of America is dangerous, to be a friend of America is fatal. UK is very dependent now on what U.S. does or doesn't do. And I think, and I'll end with this point, this is very important, and I'll stop. But there are really 5 major economic risks happening at the same time of this disjointed world right now, this conflict-driven world and this hot potato in the Middle East. I have said for years that the bond market is everything. And when you look at the bond market right now in the backdrop of this war, we're seeing rates and yields slowly creeping up, and actually currencies like the dollar and the yen going down. That's a very bad thing because when rates rise, they reflect the cost of debt. And earlier in the year before this war, banks like JP Morgan and Goldman Sachs were predicting a kind of a soft landing low rate 2026. So it's going to be very interesting to see what the Fed does. But we do know that interest expenses on Social Security, Medicare, U.S. Treasuries, our obligations they were 20% higher than tax receipts before the war. And now we have a bigger military budget for 2027. And most of the world holds our US treasuries and acts in stocks outside of our markets. So if there's a crisis, countries like UK and the EU and others are going to be dumping US treasuries and US stocks to get liquidity or cash. So the bond market is extremely fragile right now in the backdrop of this war, and it's not going to get healthier if this war continues. The second big economic risk is the stock market. It's very complacent right now. It's in this twilight zone. It's pricing in a quick war. For the last 2 months, Wall Street's been saying 2-week war, 2-week war. Well, we don't see that coming to an end anytime soon. You could argue that the Fed market doesn't, we have a Fed market, not a stock market. I've joked cryptically, you could see a mushroom cloud over Cleveland and the markets would still go up if the Fed was dovish. But I think at debt levels this big, something has to break. I believe it will be the markets. I believe it will come from the private sector. I think it will come from private credit implosion. I mean, I'm not alone in this. Even Jamie Dimon at JP Morgan is openly warning of over-levered bad credits.
Recent price action shows that gold can fall even when broader fear is rising, particularly when investors need to raise liquidity quickly. That shift matters because it challenges the usual assumption that gold will always move higher during periods of market turmoil. In this phase of the precious metal cycle, positioning, sentiment, and cross-asset stress are proving just as important as the traditional safe haven narrative. While equities appear to be pricing instability, rising debt, fragile bond markets, and geopolitical tensions suggest a more unstable backdrop. In this environment, gold continues to stand out as a preferred reserve and hedge asset, supported by central bank accumulation, persistent inflation, and weakening confidence in fiat currencies. If global financial stress continues to build beneath the surface while central banks keep increasing gold holdings, is the market currently underestimating how high gold could ultimately go in the next monetary cycle? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.